Valuation, it's difficult. It's really hard to do. How much is something worth? Looking at a piece of real estate, looking at a stock, looking at a bond, it is really difficult because it is a function of so many things. It is a function of how much cash we can get from it in the future, which we don't know. How much are people willing to pay for it in the future, which we don't know. How are we going to use it in the future, which we don't know. So there's a lot of unknowns when we go about pricing anything. However, what we will do is apply time value of money techniques as a starting point, as a foundation to price anything. So for instance, let's look at fixed income. Fixed income, looking at bonds, are probably the easiest thing, and I'm going to use that in quotes, the easiest thing to price. Why? Because there is a contract that says, I will pay this much on such and such a date. So if, big if, they actually pay that amount, we can say, okay, now we can know when the cash flows are going to occur. We take the present value of those cash flows based off of what we think interest rates should be, and we have the price of the bond. Now, that's what you probably have seen in your other finance classes already. What makes this a little more difficult is that there's no guarantee they are actually going to make those payments. So what we're looking at is the probability of payment times the payment, not just the payment. So we're really looking at the expected future cash flows, and then we're going to look at the present value of those expected cash flows. And what we will see in this class is that the probability of payment changes dramatically with bond ratings. High-rated firms usually make their payments. Companies that are low-rated oftentimes don't make their payments. And as a result, fixed income has a big range from the high ones that trade purely as fixed income to the low ones, junk bonds, high-yield bonds, etc., which trade much more like equity. So, which leads us into the next part of the price evaluation, where we will be pricing stocks. Very difficult. Very, I wish I could tell you the answer is. There are whole classes taught on valuation. I will summarize them in two basic categories. What we do, the first way, the theoretically correct way to price securities, is using discounted cash flow valuation, where we project free cash flows out into the future, and then we take the present value of those based on what we think the correct current cost of equity is going to be. Very difficult. It is hard to predict the future. It is hard to predict next year, let alone all the way out to infinity. It is a very difficult process. If we get it correct, that is the amount we should pay up until that point. However, it is very difficult to do and very sensitive to assumptions. If we make a wrong assumption, we're going to get a price move from $40 to $60 like that. So we have to use discounted cash flow valuation, and it is the correct way, but it is a difficult way. An easier, and again, not easy, but easier way is to use what I call market multiples. Market multiples include PE ratios, price to book, enterprise value to EBITDA, things like that, where what we try to do is look at firms that are comparable to the firm we are looking at and say, okay, how much is this firm relative to the other firms? So ratios, financial ratios that we're talking about, are very useful, but they're only useful in context. We need to have context. The contexts are either cross-sectionally, where we're looking at firms in the same industry, as close as possible to similar firms, to the firm we're looking at, or the firm we are looking at over time. So that's looking cross time, not cross-sectionally. So, as an example, if XYZ company always trades at a discount to the PE ratio of the S&P 500, and suddenly it changes, well, maybe something at the firm has changed, but maybe it's overpriced now, etc. So that's how we're going to do valuation. We're going to look at time value of money, the discounted cash flow valuation, and we're going to look at market multiples. And when looking at market multiples, you never look at one multiple, so we're going to look at multiple multiples, and we're going to look at it over multiple periods of time, not just now, but how it has trended over time. Hopefully, with all of those, what we do is surround the price and we get a good estimate. But again, it is difficult, and I truly believe this is the hardest thing we do in all of finance.